Infrastructure investing involves investing in essential services. This asset class plays an important role in economic development of any country as it drives job creation and urbanization. The underlying assets and businesses are often monopolies with high barriers to entry, and often the development of infrastructure as an asset class is driven by government policies and regulatory environment. As with any asset class within alternatives, infrastructure has strong diversification benefits. But what really differentiates this asset class is its inflation hedge potential and also strong income return potential due to the long contractual nature of the underlying revenue streams. In some strategies within infrastructure, investors can also achieve good capital appreciation. Infrastructure can be grouped into 4 categories: social infrastructure, economic infrastructure, industrial, and renewable energy. Social infrastructure includes assets such as schools, hospitals, prisons. It can involve a development of a new asset, in other words, greenfield assets, or it can involve an investment into an existing operation or an existing asset, in other words, brownfield investment. Those assets typically have long concessions with the government as the counterparty, and investors typically have very limited scope to add value through operations. Economic infrastructure includes investments in transport, ports, airports, water utilities. In other words, any businesses or services that are closely linked to GDP growth. Those assets typically have more opportunity to add value through operational improvements, and investors can choose strategies depending on their risk-return appetite. In other words, we can invest in economic infrastructure and expect low risk return without taking on any development or expansion risk. At the same time, we can also invest in major development projects across risk-return spectrum. Industrial infrastructure is about outsourcing non-core activities. For example, investing in wastewater treatment plant can be considered industrial infrastructure. Assessing the counterparty risk is a key to success in this type of strategy. We should also keep in mind that this sector has a limited opportunity set due to its size. Renewable energy infrastructure involves investing in wind and solar energy farms. This strategy has been gaining a lot of popularity among investors due to its strong ESG credentials and also attractive return potentials. As with other sectors, renewable energy infrastructure offers a range of strategies from low risk, low return to high risk, high return, depending on how much development risk an investor can take. Infrastructure has attracted a lot of attention from large institutional investors over the last decade. This led to increasing valuations and competitive bidding for large trophy infrastructure assets. Mid-market infrastructure, on the other hand, offers more attractive opportunities from the valuation perspective. This market segment is less competitive and opportunities there are more fragmented. That's why for investors in mid-market infrastructure, skill, knowledge, and local network is very important in order to succeed.